Hi, and welcome to this week's market presentation. Latest news. In the latest news, the US and Israel launched major military airstrikes across Iran, targeting the country's political and military infrastructure. On Saturday, Israeli and US airstrikes targeted and killed Iranian Supreme Leader Khamenei alongside roughly 50 senior government officials. In response to the strikes by the US and Israel, Iran was quick to retaliate with strikes across the Gulf, launching hundreds of ballistic missiles and drones targeting US military bases and assets in the region, but at times also leading to hitting and striking civilian areas within neighboring Gulf countries. Alongside the strikes against military assets, Iran also launched several drone attacks against Qatari LNG infrastructure facilities, forcing Qatar Energy to halt LNG production for the time being. Saudi Arabia saw similar strikes in its territory, with drone strikes targeting the Ras Tanura refinery, resulting in its temporary shutdown. In response to the retaliatory strikes by Iran against Gulf countries, Gulf states issued a joint condemnation of Iranian attacks, affirming the right to self-defense, but so far not joining the US or Israel in offensive operations. Hezbollah entered the conflict as well, following the reports that Supreme Leader Khamenei had been killed, launching several missiles and drones against Israel. The Israeli response was quick, with several airstrikes against Hezbollah in southern Lebanon. It remains to be seen how long this conflict will go on for. President Trump has indicated that the US is prepared to maintain its military campaign against Iran for weeks. The president has called for the Iranian people to overthrow its current regime, as it remains questionable whether the US goal is regime change in the country or merely to bring the Iranians back to the negotiating table to discuss its nuclear program and its conventional forces posture. The impact on energy markets was quick and significant, given the halt of transit through the Strait of Hormuz, especially following the warning from the Revolutionary Guard from Iran regarding passage of vessels across the strait. European gas prices surged 50% following the announcement by Qatar Energy that it would be halting production. Crude oil prices similarly saw its sharpest increase in some time, pushing Brent crude oil prices to the highest level since June of 2025 at just over $82 a barrel. For European energy markets, while in the past Qatar was a very significant supplier of LNG into Europe, as the European Union and European countries move towards US LNG exports instead, we've seen a dependency on Qatari LNG significantly decrease. In 2025, it was less than 8% of Europe's LNG supply. Nonetheless, given that LNG is priced globally, the extended halt of LNG flows through the Strait of Hormuz, a majority of which goes towards Asian consumers, China being a primary buyer of LNG from Qatar. We could certainly see a sudden and continued increase in global LNG prices, pushing up the price competition between European and Asian consumers, and in turn increasing the price level for European gas prices. Weather. Moving towards the latest weather forecast, weather conditions across Europe are forecasted to remain noticeably above the seasonal average over the next 7 to 10 days, continuing the trend of mild weather we've seen over the past week. Precipitation, however, will remain limited across Europe over the same period of time, which for the Nordic region, which is already facing a hydro storage deficit versus the past 15-year average, will be unwelcome news. Lastly, wind speeds are expected to remain in line with the levels we saw over the past week. Macroeconomics. In terms of the macroeconomic indicators, we note the quarter-over-quarter GDP figures for the US and the UK. For the US, showing a significant slowdown in economic growth in the last quarter of the year. Yet to be seen if that trend will continue. In terms of PMIs, we note the limited movement in PMI figures of both manufacturing and services sector, as we can see here, although it must be noted the improvement in the euro area manufacturing PMIs up above the 50-point level once again. Crude oil and LPG. Looking towards crude oil prices, the previous weeks had been seeing a steady increase in the price level in anticipation of military conflict in the Middle East. So at the end of last week, we saw limited upward movement. However, as we noted earlier, as markets opened today, we saw a sudden surge in the price level with Brent crude oil prices increasing above $82 per barrel in the morning, while settling down by the end of the trading day to just around $79 per barrel. Markets are still not pricing in an extended halt to oil flows through the Strait of Hormuz or significant damage to the region's oil and gas infrastructure. As the conflict continues and potentially escalates further, those assumptions will certainly be tested, and as a result, we could certainly expect for oil prices to increase even further if we start to see continued Iranian attacks against the region's oil infrastructure. In the face of the situation in the Middle East, other factors remain bearish for crude oil, particularly the continued oversupplied expectations across global markets. Although, if we do see that halt to flows out of the Gulf, that would certainly see the current expected surplus be entirely eliminated, potentially causing a noticeable supply shortage in the short term, which is one of the reasons why crude oil prices could increase even further. Natural gas. Natural gas prices in Europe, which saw a relatively stable price evolution over the previous week, saw a significant increase throughout this Monday following the market opening after the war in Iran started. Remains to be seen what the future price evolution will be, but for the moment, most of the increases were in the short term, particularly for the front month, which with increases further along the curve for the front year, for example, are at more modest ranges. Adding to the bullish sentiment in the market are the still low gas storage levels, with storage levels near the lowest levels over the past 13 to 14 years. Fortunately, the warm weather over the past week, coupled with the forecast of warm weather over the next 7 to 10 days, is easing withdrawal expectations, which have already moved from larger than the past 5-year average of the previous week to near the lowest levels of withdrawals for this time of year. The smaller withdrawals from storage have in turn helped reduce the deficit versus the previous year to around 8%. The main factor reducing the level of withdrawals from storage was the sharp decrease in total demand as weather conditions resulted in lower total demand for natural gas. An increase in renewable power generation as well resulted in a decrease from the power sector as well, even as total supply remains largely unchanged week over week. Europe had been seeing increasing LNG imports over the previous couple of weeks, and since the beginning of the year, the situation in the Middle East will certainly test the ability for Europe to maintain its preferred level of LNG imports. One positive factor is certainly the lower total demand for LNG out of Asia so far this year, as seen by the lower share of LNG exports going to Asia. But as we mentioned earlier, the significant amounts of LNG flowing through the Strait of Hormuz, which are currently halted, will certainly have an impact in that price competition. Coal. Looking at coal markets next, we note limited price movements over the past week following the increases over the preceding couple of weeks. Following the surge in natural gas pricing we've seen today, we're likely to see additional demand for coal imports into Europe as a result of the potential increase in the level of gas to coal switching from the power sector. EU and UK emission allowances. European carbon allowances saw a decrease over the past week following that rebound 2 weeks ago in the market. Overall price levels has remained a little more neutral over the last couple of weeks, but nonetheless significantly lower than what we've seen over the previous couple of months. Overall, the main driver of the decreases continue to be those reports that the European Union is discussing easing some of the tightness in its regulations regarding carbon allowances, which could result in lower demand for allowances and in turn lower prices. On the UK side of things, the main factor keeping prices at elevated levels remains the discussions regarding linking the EU and UK markets. Power sector emissions, which decreased noticeably over the past week, are expected to remain low given the current weather forecast for the next week and a half. Investment fund positions, which had been decreasing over the previous weeks on the back of those lower prices, will certainly be tested starting this week following the war in Iran and what that could mean regarding emissions in Europe as a result of potential greater use of coal versus gas, as well as the potential unforeseen impacts that the war could have on the European economy and the European energy market. Electricity. Looking at electricity markets next, prices had been easing off over the previous week, especially in the longer term, partly driven by the stable natural gas price evolution and the decreased price level for carbon allowances. This was certainly reverted starting this Monday with a rebound in the market following the surge in gas pricing that we discussed earlier. The recent price evolution had been pretty uniform across European countries, with pricing having decreased across the board over the previous week. Total demand across Europe followed a similar evolution as demand for natural gas, with weather conditions reducing demand to now the lowest levels in over the past 5 years. In terms of the supply mix, nuclear power generation, followed a similar evolution as previous years, decreasing slightly over the past week. Renewable power generation, although easing off slightly due to a decrease in wind power generation, remained at the highest levels in over 5 years, which helped contribute to the decrease in fossil power generation down to the lowest levels of output over the same period of time. As we noted, while wind power generation decreased over the past week, solar power increased more than enough to make up for the decrease in wind power output. At the same time, fossil fuel power generation decreased across the board, particularly when it came to gas and coal. Interesting to see how that will evolve over the coming weeks, especially if we see that continued surge in gas prices. As we mentioned earlier, the limited precipitation that we've been seeing so far this year has certainly hurt the current hydro level deficit in the Nordic region versus the average since 2015, with concerns over future hydropower generation, particularly for the remainder of this year, weighing on power prices in the region. Lastly, guarantees of origin pricing saw pretty stable evolution over the past week following the bullish evolution we saw over the previous 2 to 3 weeks. Overall pricing remains competitive historically speaking, but we still see some potentially additional buying demand and demand expectations, particularly from the expected demand growth for power consumption from data centers and AI-related loads, although the strong performance out of renewables certainly easing some of the expected tightness in the market. That covers this market presentation. Thank you for joining.